Thus, every transaction involves two aspects of equal value. The amount which is received while selling the goods, that is known as revenue. If you add the total liability and capital, it should be equal to total assets. So, accounting conventions may be defined as a custom or generally accepted practice. Hello everyone, I am Harshita, lecturer, Department of Commerce, Vidhyaashram PU College, the Temple of Excellence, Mysuru. My dear students, we were discussing chapter 2, that is theory base of accounting, that is from part A of your accountancy syllabus, and today we are in the second session. My dear students, we were discussing about the accounting concepts. Now, what do you mean by accounting concepts? So, these are the rules or assumptions to be followed while recording in the books of accounts, and in our previous session, we have already learnt few of the accounting concepts. In today's session, we shall continue with one more accounting concept, that is dual aspect concept. Now, what do you mean by dual? Dual means two. So, for each and every transaction, there are two effects. One is taking effect as well as one is giving effect. Now, let us see what is this dual aspect concept. So, every business transaction always results in receiving of some benefit of some value and giving of some other benefit of equal value. For example, I'll give an example here. The organization have purchased furniture worth rupees 20,000. Now, this is a transaction which have taken place in a organization. Now, whether we have to record this transaction? Yes, because this transaction is measured in terms of money, that is in terms of monetary units. Now, what is this dual aspect concept? So, here if you see this transaction, there is a taking effect, at the same time there is a giving effect. Now, we have purchased furniture worth rupees 20,000. So, what comes to the business? Furniture. So, furniture is what? That is taking effect. So, furniture comes into the business. At the same time, when we purchase furniture, we have to pay cash worth rupees 20,000. So, here giving effect is what? Cash. So, because cash goes out of the business. In the same way, we will record those transactions in the books of account which has two effects. One is taking effect and the other one is giving effect. So, if you see the example itself, furniture comes into the business whereas cash goes out of the business. So, here these transactions should have certain value, because in this transaction, the value is worth rupees 20,000. Example, when a business concern sells rupees 1,000 worth goods. So, here they have given the example of sales. Now, the business have sold goods worth rupees 10,000. It receives cash of rupees 1,000 and gives goods worth rupees 1,000. Here, they have sold goods. So, goods goes out of the business, where in return what comes into the business? That is cash. One is going and the other one is coming. So, one is giving effect, other one is taking effect. Thus, every transaction involves two aspects of equal value. Of course, goods worth rupees 10,000 goes out of the business, whereas cash worth rupees 10,000 comes into the business, but the value is same. Whether it is giving or whether it is taking, the value is same. So, dual aspect concept means every transaction has a dual or two aspect and should be recorded in two places. So, we have to record it in two places. Dual aspect is a basic principle of accounting. So, for each and every transaction, so I have already told you about double entry system of bookkeeping, where two of the aspects will be recorded, right? So, either debit or credit. Here also, this dual aspect is nothing but double entry system of bookkeeping. So, dual aspect is the basic principles of accounting. It provides the basis for recording the business transactions in the books of accounts. In fact, this concept, the core of double entry system. Now, which is a core of double entry system of bookkeeping? That is dual aspect because it has also two effects. One is giving as well as taking effect. The duality principle is commonly expressed in terms of fundamental accounting equation. So there is a fundamental accounting equation for this dual concept. So accounting equation is always based on dual concept. So what is the accounting equation? Assets is equal to liabilities plus capital. So you have to remember here. So accounting equation is based on dual aspect concept where the accounting equation is assets is equal to liabilities plus capital. So what does it mean? If you add the total liability and capital, it should be equal to total assets. So same formula can be reversed, like if we want a liability, so liability is equal to assets minus capital. If we want capital, then assets minus liability. So this is a accounting equation. So they might ask a question, what is accounting equation? So what is accounting equation? So it is nothing but assets is equal to liability plus capital. So the total of liability and capital should be equal to total of assets. So this is about dual aspect concept. And the next one is revenue recognition concept. Now what do I mean by revenue recognition? So revenue, I have already told you, the amount which is received while selling the goods, that is known as revenue. Now let us see what type of transaction that has to be recorded in the books of account. The concept of revenue recognition requires that the revenue from the business transaction should be included in the accounting records only when it is realized. Now we will record those transactions where the revenue is coming into the business only when it is realized. And revenue is to be recognized or considered to be realized only when the goods and services are transferred to the customer and the customer becomes legally liable to pay for them. So for example, if the organization has sold goods worth rupees 20,000. Now, this transaction has to be recorded even though if they have not received the amount. Because, for example, if the sales are made on credit basis where the cash is not received immediately. In such cases also, we will record the transaction even though if the cash is not received on that particular day. So, for example, if this transaction have occurred on 1/1/2016, immediately we will record that transaction in the books of account even though the cash is going to receive in the future. So revenue recognition means what? So we will record those transactions when it is realized. So only when the goods or services are transferred to the customer and the customer is legally liable to pay for them. So for example, credit sales are treated as a revenue or income on the day when the sales is made. So when the goods are sold to the customer on that day itself, it will be recorded in the books of account and not when money is received from the buyer. For example, I have told you on 1/1/16, the organization have sold goods worth rupees 20,000, but on 20th 1/16 they are going to receive the amount. So under revenue recognition concept, it is that we will record the transaction when it is actually occurred but not when the amount is actually received. So this date will not be, or on the amount or on the date on which the amount is being received, that date is not considered. So we will consider this date where the transaction have been actually occurred. So this is about revenue recognition concept. We will record the transaction in the books of account when it is actually occurred and not when the amount is actually received. And the next one is matching concept. So here we are going to match the revenue of the organization with the expenses of the organization. So here matching concept, the word itself says that we are going to match the total revenue with the total expenses of the organization. So it means to measure the profit and loss of the business for an accounting period, all the expenses incurred should be matched with the revenue. So here the income or the expenses which is incurred should be matched with the revenue earned during that accounting period. So we have to match the total revenue with that of total expenses. Thus, according to matching concept, all revenue earned during that accounting period, whether received during that accounting period or not, and all costs incurred, whether paid during the year or not, should be taken into account while ascertaining the profit or loss of that particular period. So, financial statement will be prepared at the end of the financial year to know profit or loss as well as the financial position of the business. In order to know the exact financial position, we can connect this concept with that of revenue recognition concept. So here we will match the total revenue as well as total expenses, and even though if it is not received also, we will take that transaction. So what is a revenue recognition concept is that we will record that transaction on that particular day when it is actually occurred and not when the amount which is been actually received. Here also we are going to take this revenue and expenses and we are matching this revenue and expenses and will take the transaction when it is actually occurred, not when it is actually received or paid. So that is under this matching concept. So what you have to remember, under matching concept, we are going to match the total revenue and total expenses of the organization to ascertain the profit and loss of the organization. But while recording or while ascertaining or while matching the total revenue and expenses, we have to take into consideration of revenue recognition concept also, which tells that we are going to record those transactions when it is actually occurred and not when it is actually received or paid. That is about matching concept. Next is accrual concept. Now, what do you mean by an accrual concept? It means that a revenue accrues in the year in which they are earned and not in the year in which they are actually received, and expenses accrue in the year in which they are incurred. So, this is also will be a combination of revenue recognition concept. So, it tells that we will record those transactions. We will record the transaction when it is actually occurred and not when it is actually received or paid. So, the amount may be paid in the future, the amount may be received in the future, but we will record the transaction when it is actually incurred or when it is actually occurred. So, that is about accrual concept. Here the payment or receiving the amount may be in the future, but the transaction when it has been actually taken place, that will record in the accrual concept. Next is objectivity concept. Now, what is objectivity concept? It means that all accounting entries should be based on objective evidence. So, I have already told you in your previous session. So, whenever you record a transaction in the books of account, it should have a proper documentary evidence. So, without which the transaction cannot be recorded in the books of account. Here also the objectivity concept tells that it means all accounting entries should be based on objective evidence, that is supported by a verifiable document such as vouchers, invoice, cash memo, receipts. So everything should be there in order to record the transaction. I have already told you when you record the transaction in the books of account. So these are the transactions. So for each and every transaction, now if I am going to write the first transaction, I should have a proper documentary evidence. I should have a evidence. So it may be in the form of this receipts, or it may be in the form of vouchers, or it may be in the form of cash memo. So such documentary evidence should be there whenever I record the transaction in the books of account. In the same way for second entry, if I want to record the entry in the books of account, that is second entry, I should have a proper documentary evidence, without which I cannot record the transaction in the books of account. So here this objectivity concept is that each and every transaction should have a objective evidence. That is a supporting documentary evidence. The evidence must be objective, that is free from bias of accountants or others, and must be subject to the verification by auditor. So it should be free and it should be clear. So here the verifiable document should be clear. It should be signed by the authorized person and it can be audited by the auditors also. That is during the process of auditing. So each and every entry will be checked by the auditor with the respective documentary evidence. So here objectivity concept tells that each and every transaction should be recorded with the documentary evidence. Next is accounting conventions. Let us see the next concept. So until now we have discussed about accounting concepts. Now let us see what is this accounting conventions. So it is also one of the type of accounting principle. So let us see what is this accounting conventions. So accounting conventions may be defined as a custom or generally accepted practice. So what is accounting convention? So it is also a custom or generally accepted practice which is adopted either by the general agreement or by the common consent among the accountants. So here these conventions are made by the accountant itself, which is custom as well as generally accepted practice. Accounting conventions differs from accounting concepts. So we have already discussed about accounting concepts. So accounting concepts are assumptions or rules to be followed while recording in the books of accounts. Then what is this accounting convention? So it is a custom or generally accepted practice which is made by the accountant itself. So let us see the difference between these two terms. So if you see the first difference, it is difference between accounting concepts and accounting conventions. So if you see the first concept here, that is difference, legal position. So under accounting concepts have legal acceptance. So here accounting concepts will have legal acceptance, whereas accounting conventions are guidelines. So it is a guidelines based on custom or usage or general agreement. So how it is formed? So it is formed by the custom or usage or general agreement. Now coming to the next one, recording versus financial statement. So under accounting concept are the basis or basic assumptions on the basis of which transactions are recorded and the accounts are maintained. So it is a basics assumption where the transactions are recorded in the books of account, that is accounting concept. Then what is accounting conventions? Accounting conventions are followed in preparing the profit and loss account as well as balance sheet. Now what you have to remember, accounting concept is just pertaining to recording of business transactions. So it is a assumption in which the transaction are being recorded in the books of account. But in case of accounting convention, so it is mainly used in the preparation of financial statements like profit and loss account as well as balance sheet. Next, significance. So if you see the third difference, significance. So there are uniform set of rules. So under accounting concept, there are uniform set of rules usually followed in recording the transaction. So here accounting concepts are similar to every organization. So there is a uniform set of rules to be followed. But in case of accounting conventions, these are not so important as accounting concept. So the main intention of accounting concept is to bring the uniformity in the accounting statement, whereas accounting conventions is not that important as that of accounting concepts. Next, fourth difference is role of personnel. So there is no role of personal judgment or individual bias in the following of accounting concepts. So there will be no bias. At the same time, there is no personal judgment or individual judgment under accounting concept. But coming to accounting convention, personal judgment may play a crucial role in the adoption of accounting convention. So here the personal judgment can be applied. Whereas in concept, so they are set of rules where there is no personal judgment, there is no bias also under accounting concepts. Next, difference is that uniform adoption. So there is uniform adoption. So each and every organization has to follow accounting concepts in order to bring uniformity. So there is uniform adoption of accounting concept in different enterprise. So different enterprise have to follow the same accounting concept. But in case of accounting convention, there is no uniformity in the adoption of accounting conventions in various enterprises. So here it is not necessary that each and every organization has to follow a similar type of accounting conventions. But under accounting concept, they have to follow, because in order to bring the uniformity so that their accounting information can be compared from one organization to another. So these are the few differences between accounting concepts and accounting conventions. Now let us see few of the accounting conventions. So we have already learnt about accounting concepts. So there are few of the accounting conventions. So if you see the first one, the first convention is convention of materiality. Now what do you mean by convention of materiality? It means in accounting, the detailed record made only of those transactions which are material, that is, which are significant in nature. So of course, I have told you, in the business organization, there are number of transactions which takes place daily. But all the transactions are not material in nature. But in accounting, we will record only those transactions which are material or significant in nature to the users of accounting information. So this materiality concept is that we will record only those transactions which are material or significant in nature. No detailed record is made of transactions which are not material or insignificant in nature. So what you have to remember here, under materiality concept, it is that we will take only those transactions which are material in nature while recording in the books of accounts. Example, according to materiality convention, when a pen worth ₹20 is put to use, the entire amount of ₹20 is treated as an expense immediately, though the pen may be or may not be used or may be used for only few days. Of course, they have purchased a pen worth ₹20. Now, what we have to record in the books of account, we have to record it as ₹20 itself, even though if we have used or even though if it is not been used in an organization. But what the amount which is been spent, that has to be recorded in the books of account. So if it is not used, then whether it can be deducted or whether it can be taken off from the books of account, no. We have already recorded, and whether it has been used or not, but we have to record in the books of accounts. So materiality concept is that we will record only those transactions which are material in nature, and the transactions which are not material or insignificant in nature are not recorded in the books of account. Now moving on to the next conventions. So we have learnt about materiality concept, that is convention of materiality. Now we shall learn about convention of conservatism. So what do you mean by that? Be prepared for the worst. So let us say, what is this convention of conservatism? So it means in accounting records and in financial statements of a business, all prospective losses should be considered and provided for, but not prospective profit should be ignored. So here what they are telling, so we have to be prepared for the prospective losses which may occur in the future, but we are not prepared for the prospective profit. So we are ignoring the prospective profit, but we have to give importance for the prospective losses which are going to occur in the future. So in short, according to this convention, provide for all those possible losses but anticipate no profit. So don't expect profit. So always be prepared for the losses. So if you are prepared for the losses, of course you can handle the situation very easily. So always be prepared for the worst. So whatever the measures that has to be taken, so anticipating the future losses, so whatever the measures that has to be taken in the present period, so we have to take that, but don't anticipate the profit which comes in the future. So valuing closing stock at cost or market price, whichever is lower, creating provision for doubtful debts. So what do you mean by doubtful debts? The amount which is not recovered from the debtors. So that is known as what? Doubtful debts, right? So make provision for that. So make provision for doubtful debts or bad debts which are not recoverable in the future. So this sentence tells that provide for all possible losses. So be prepared for the losses and make or take some measures in order to anticipate those losses. So bad debts are some of the examples for application of principle of conservatism. So it's nothing but be prepared for the worst. So whatever the measures that has to be taken in order to reduce the loss in the future, so that measures has to be taken properly. So if any reserve has to be created for the bad debts or doubtful debts where the amount is not recoverable in the future, so we have to make provisions for that and we have to be prepared for that losses. So that is about convention of conservatism. Next one is convention of consistency. So what do you mean by consistency? In the sense, say following the same method. So that is known as consistency, or same is nothing but what? Consistent. So it means the accounting policies and practice should remain consistent. For example, in 2019, we have followed a different method, that is to calculate the depreciation, and in 2020, we are following other different methods to calculate the depreciation. So here it doesn't, or it means that we are not following the consistency because we are changing the methods. So if we change the methods, so it will be quite difficult to compare the accounting results of one year with that of another year. So always make sure that whenever we record entries in the books of account, so it should be recorded in that of same methods. We should not differ the methods of recording in the books of account. So it means that accounting policies and practices, so whatever the policy and practice what we are following while recording in the books of account, it should be consistent, that is uniform or unchanged from one accounting year to another accounting year. So if we follow different types of method year after year, then we cannot compare the accounting results because the method what we have applied is totally different. Example, when once a particular method of depreciation is adopted for a particular fixed asset, the same method should be followed for that asset year after year. So I have given the example of depreciation itself. So in a particular year, if we are following straight line method, in the next year also we have to follow the straight line method itself. So we cannot follow the written down value method. According to Indian accounting standard, consistency is fundamental assumption. So it is what? It is a fundamental assumption. These conventions enable a meaningful comparison of the accounting figures from one year with that of another year. So the main intention of following this consistency, because the accounting results can be compared from one year to another year, so that they can know what is the improvement they have to make from one financial year to another financial year. That is conventions of consistency. Next is convention of full disclosure. So let us see what is this full disclosure. So it means that all material facts, of course, in convention of materiality, we have studied that we will take only those transactions which are material in nature, which are useful in nature. So it means that all material facts relating to the accounts must be disclosed in the financial statement with sufficient details. So we have to disclose all the material facts in the financial statement. Then only we can get the proper financial result. Example, in case of sundry debtors, not only the total amount of sundry debtors should be disclosed, but also the amount of good as well as secure debtors and the amount of doubtful debt should be mentioned. In the same way, if we take the fixed asset, it's not just that we are going to write the value of fixed asset. So if there is any appreciation or depreciation, so we have to take that also. So here full disclosure in the sense what? So all the details to a particular asset or liability has to be fully recorded in the books of account in order to ascertain the correct financial position. So the idea behind this convention is to enable the users of financial statement to make the proper decisions. Of course, if the financial statement is correct, then we can communicate that financial statement or financial information to the user, so thereby they can take their right decisions. So what we have to do, so whatever the aspect relating to particular asset or liability, so we have to disclose each and every aspect. Whether it may be a minute aspect, we have to record in the books of account. The practice of giving notes related to various facts or items which are not find place in accounting statement is accounting to this convention. So according to this convention, what does it tells? So if any information is missing, then we have to give a proper note. So if all the information are there, then we have to correctly record that in the books of account, so that the financial information will be correct and it can be directly communicated to the users. That is convention of full disclosure, in the sense we have to disclose every items relating to a particular asset and liability. So we should not ignore any of the items unless it is insignificant in nature. So in my next session, we shall discuss about accounting standards. So in today's session, we have learned few of the accounting concepts, as well as we have learned few of the accounting conventions. So we have learned what is accounting conventions and what are the conventions which are included in accounting. So in my next session, we shall discuss about accounting standards. So let us see what is this accounting standard is all about, and there are various accounting standards we are going to discuss in my next session. So my dear students, this is all about today's session. In my next session, I am going to discuss with a new concept. Till then, take care. Thank you.